Janet, thanks for joining us.
You're welcome. Good to be here.
Your firm operates a newsletter, and it also has several mutual funds, and you focus on investing in different funds. And I noticed that unlike, for a long time, Forbes has preached value investing, Graham and Dodd, that kind of thing. But momentum investing, it seems to be something that you guys focus on, and it seems to work. Tell me, how, is there any value component to what you do, and why is momentum investing, why does it work?
Well, our strategy of upgrading is basically a momentum strategy. I prefer to call it persistence of performance. It's really based on the observation that when a fund has excellent performance, it continues for a while. We don't know how long, but there is momentum.
Your newsletter and your funds are kind of fund of funds. They invest in other funds. Right now, mutual funds are somewhat under attack by ETFs. ETFs are really the most popular investment now. All investors are all asking for ETFs. Where do you fall? What camp are you in, ETFs versus mutual funds?
Well, we use them both. ETFs are index funds for the most part and have been around for a while. We've always used index funds when they are doing well. The difference between NoLoads, a typical no-load fund, all no-load funds rather, trade at net asset value. With an exchange-traded fund, there's a spread between the bid and ask. So slight complication for some investors. They have to be aware of trading. That being said, ETFs give access to any number of market segments and geographic regions. There's really no difference. Access can be had in no-loads or ETFs.
So you're agnostic about what type of fund vehicle you
Absolutely.
use. But ETFs, one of the things that mutual funds still have are actively managed funds, and it's been very difficult for ETFs to kind of get into that market. When you look at your model portfolios, are you still finding that are they mostly made up of index-type funds or ETFs, or
in different market environments, it's different. In 2008, for instance, mostly actively managed funds that could go defensive, could hold more cash, tended to rise to the top. ETFs as index funds typically don't hold much cash. So it's easier for an active manager to get defensive. There are indexes for anything. One fund that's come up our ranks recently follows the Sentient Insider Trading Index. So they gather, it's a Guggenheim fund now. They gather all the public information about what insiders are buying and have an index. So, you can create an index for anything. That fund has had pretty decent performance lately, NFO.
NFO, so it buys based on insider buying.
That's right, yeah.
Interesting. Most people are sold their mutual funds, and when brokers or whoever sells mutual funds, they always talk about Morningstar ratings. Morningstar is kind of the king in the rating business right now. What's your feeling about the Morningstar ratings? You kind of have your own rating service.
Yeah, we do have a specific selection process, and the big difference, I guess, between, first of all, I admire Morningstar. They present lots of good information, but their star system is not predictive. Even they will tell you that. They really don't recommend using only their star ranking to select funds, whereas we do. Our ranking system is a firm recommendation by the funds that are highly ranked in our system. Our selection process is very different. Morningstar looks at 5-year and 3-year records. They're very concerned with analyzing the manager, the fees of the manager. We don't think that makes any difference. We're really focused on current performance.
And so you're not really concerned with, we always talk about long-term performance, 10-year plus, 5-year plus. It's not really baked in, nor are fees.
Our studies have actually shown that the longer term the performance period you're using, the less predictive it is. So we've, of course, run studies using 1-year, 3-year, and 5-year performance records. The returns are simply not as good. Same with fees. We continually test selecting funds only with low fees, and you have very mediocre returns. It's not a good way to select funds. When you look at the top performing funds in any period, long-term or short-term, the fees are ranging from lowest to highest.
Lots of our audience they have 401ks, and half of the people you talk to are bewildered about how to go about managing their 401k. Most of them have ETFs in them and mutual funds. Any advice on, say, managing that all-important retirement account?
It is important. I think, first of all, investors really need to zero in on an allocation they're comfortable with so they can stick with a strategy or a discipline. Many strategies, disciplines for selecting funds work, but stick to it. Get an allocation that can allow you to ride through the markets up and down short term. So whether it's 30% in fixed income or 70% in growth, a lot of that depends on your age, when you're going to use the money. If there's any money that is going to be invested for over 20 years, it should be in growth. It should be in stocks. Bonds are used typically to temper the volatility, but come up with your allocation between bonds and stocks, and then select funds based on current performance. Stick with the funds that are doing well. As long as you're with NoLoads, it doesn't cost you anything to upgrade. So when the market changes, sometimes you have to change to align with what's working.
So just don't pick a portfolio and forget about it. You have to pay attention.
I think the more active you are, the better returns you're going to have.
Interesting. Okay, so why don't you talk to us a little bit about what's working now? What areas, sectors, funds are kind of high up on the NoLoad Fund X list?
Mid-cap funds have consistently been pretty good for the last year or two. You know, energy has led among the aggressive funds. We're also seeing a lot of healthcare funds rise up the ranks, including biotech. Financials are at the lower end. But among the diversified funds, mid-caps have been pretty good. MDY is a mid-cap ETF that we've held going on 2 years now.
My last question for you, and a question that most investors ignore. How do you know when to sell your mutual fund? You know, when do you sell a fund?
I think you've got to have a discipline. As you said, it's easy to know what to buy. You buy the top performers, but when do you sell? We have tested different sell thresholds and determined that for us, staying in the top 30% of a risk class is what produces the best returns with acceptable turnover. So we say stay with a fund as long as it's in the top 30% of its risk class. Falls below it, and I've had questions, you know, saying, wow, you have a lot of sells in your newsletter. You must be bearish. Not at all. It's just that the system really focuses on keeping us in that top 30%. So by necessity, we say anything in the lower 70% in our system is a sell.
So keep buying winners and sell your losers.
That's
sell your
it,
laggards.
Matt. Yeah.
Thanks very much, Janet.
Thank you.